In last week's video, I talked about the framework we use when assembling client portfolios based on three specific goals that every investor has. That is security, income, and growth. We talked about how each person has their own unique blend of those three goals and how important it is to match your particular portfolio to your particular goal. In today's video, we're going to take the next step and talk about these specific portfolios, the models we use to match goals to client situations. Here are the 5 investment strategies that we actually build with, and which one of those 3 objectives or blend of objectives does each one fit. The first strategy we're going to discuss is our fixed income strategy called preservation of capital. Every other strategy we're going to discuss is a stock strategy, and in most cases we will blend a stock strategy or multiple stock strategies with our preservation of capital, which creates what we call endowment. So if you ever hear one of our advisors talk about endowment Cornerstone, for example, that refers to a mix of our rising dividend Cornerstone stock strategy with our preservation of capital fixed income strategy. Out of the box, preservation of capital sits between the two objectives, security and income. At DCM, we only buy investment-grade fixed income securities, including municipal bonds, corporate bonds, treasury bonds, preferred stocks, and in some cases, fixed income ETFs. And we do that to provide a ballast. In the event that you do have a recession, stocks generally drop, sometimes by a lot, so adding fixed income to a portfolio can help mitigate some of that downside volatility. And the higher credit quality you go up, the better those tend to diversify a stock portfolio. The fixed income also provides generous income stream. If you look at investment-grade corporate bonds as a whole, the current yield is approximately 6% on those bonds, according to the Federal Reserve. And looking at the SEC yield on PFF, which is a preferred stock ETF, the 30-day SEC yield is approximately 6.5%. This blend of security and income is why adding preservation of capital to an equity strategy is often very attractive. Blending a fixed income portfolio with a 6% yield with a stock portfolio at a 2% yield combines to have an average of right at 4%, which produces a meaningful income stream for retirees. And just like all of the other strategies we manage, preservation of capital can be customized based on your specific needs. We manage all of our strategies individually for each person. There's not a particular fund that we use and we assemble. Each person has their own unique portfolio. So your portfolio of fixed income is going to look different from another person's. And that allows us to customize things based on your particular need. So let's say you're someone that wants a little bit more income. We could tilt your portfolio to a little bit more preferred stocks and that 6.5% yield. Of course, that's going to naturally pull a little bit away from security, but it will generate more income. On the other side, if you're someone who valued security a little bit more, we could stick closer to municipal bonds if you are someone with some tax sensitivities, extremely high investment grade corporate bonds, or for the utmost safety, buying US Treasury bonds. So within preservation of capital, there's a lot of room to customize what you're looking for with what your portfolio can provide. For more information on how that would work with your particular situation, you can talk to one of our advisors. We'd be glad to sit down and talk to you about what your specific needs are and how we can meet those with a customized portfolio. Next, let's talk about rising dividend Cornerstone, or Cornerstone for short. We've managed Cornerstone since the mid-1990s, and it's become our most popular individual stock strategy. The reason it's become so popular is that Cornerstone sits right at the intersection of security, income, and growth. And for retirees, especially early retirees, this is a very attractive combination. Within Cornerstone, we seek to provide an above average income yield. This depends on the overall market yield. So if yields are lower, like they are now, Cornerstone will have a little bit lower of a yield. Currently about 2.0 to 2.1% dividend yield at the moment. This will fluctuate over time. depending on where we see opportunity or where the overall market yields are at. And we pair that income generation with dividend growth. So we typically look for an overall portfolio dividend growth rate target of around 8% per year. And our belief is that this dividend growth rate will ultimately drive stock prices. And finally, we have security. For Cornerstone, we seek to own a diversified portfolio of around 30 to 35 different stocks across all different major market sectors. And within each stock, we seek to purchase companies that have strong balance sheets, excellent cash flows, and long histories of paying and growing their dividends, even during times of recessions or bad economic environments. Many of the companies in Cornerstone are Value Line's safety rating 1 or 2. Value Line is a third-party firm that ranks stocks on a scale of 1 to 5, with 1 being the highest safety and 5 being the least safe. At the time of this video, there were less than 100 stocks that had Value Line safety ratings of 1 out of several thousand. If you want to know more about Cornerstone or any of the other strategies on this list, we'll be producing dedicated videos to each one of the strategies over the next couple of weeks. So be sure to hit the subscribe button and the bell icon so that you can get notified whenever those videos are released. Next, let's talk about Income Builder. Just like Cornerstone, Income Builder focuses on a portfolio of between 30 and 35 different stocks, also diversified across different sectors. The difference between Cornerstone and Income Builder is in the income. While Cornerstone tends to be right in the middle of security, income, and growth, Income Builder tends to push more towards the income component, hence the name Income Builder. Where Cornerstone's dividend yield was right around 2%, Income Builder's yield is over 3.5%. And as we talked about in last week's video, when you push towards one particular characteristic, you give up a little bit on the others. In Income Builder's case, the higher yield generally means we get less dividend growth than we would in a strategy like Cornerstone. For Income Builder, we look for the strategy as a whole to have dividend growth right around inflation so that clients who are living on the income being generated by Income Builder will be able to increase their living expenses to at least keep up with inflation. Next, we have our most growth-focused strategy, Sequoia. Whereas Cornerstone was focused on the blend of security, income, and growth, Income Builder is focused more on income, security, and then growth. Sequoia is focused entirely on growth. Sequoia's strategy is 20 individual stocks, and the intent with this strategy is really as a supplement to our other strategies. So for example, if you had a portfolio of Cornerstone, but you also wanted to tilt a little bit more towards growth, we could add a sleeve of Sequoia or put Sequoia in a separate account like a Roth IRA and tilt your overall household more towards growth. Therefore, Sequoia itself is a little bit more of a concentrated portfolio in just 20 stocks. Each one of those stocks is equal weighted at 5% at the beginning of each quarter. Sequoia is also unique in that it's our only purely quantitative strategy. So to decide what 20 stocks make it into Sequoia, we start with a list of high conviction hedge fund positions. 50 stocks make that list. And then we have a proprietary algorithm that we employ that will pick the top 20 stocks out of that list of 50. And then each quarter, we rebalance those 20 stocks, each back to 5%, and then replace any stocks that have fallen out of this list of 50 or that have fallen below 25th percentile in our algorithm. We'll go into more detail on Sequoia and the other strategies in the next couple of videos. Again, this is just supposed to be a high-level overview of the different strategies that we offer and where each one fits. And finally, we have our newest strategy, and that is Navigator. Navigator is our flagship active ETF strategy. It uses the same investment research that we employ in our investment policy committee, only rather than using individual stocks, for Navigator we use ETFs. We'll talk more about how we select, weight, and rebalance those ETFs in the dedicated Navigator video. But for the purposes of this video, Navigator is really a blend between security and growth. Whereas the Sequoia strategy was entirely focused on growth, concentrating in 20 stocks, Navigator tempers that growth potential with broad diversification. For example, if you look at the underlying stocks within the Navigator ETFs, there is exposure to over 7,000 different stocks. Navigator also adds some exposure to international stocks, so it's broadly diversified across virtually all equity styles, including large, mid-cap, small-cap, growth, value, international, and domestic. And for the growth component, we've selected a basket of ETFs that tilt the portfolio towards evidence-based factors. And we'll talk more about these factors, what they are, what they mean, in the dedicated Navigator video. But the intent of this strategy is to provide the long-term growth and diversification benefits of a broad market strategy, combined with the active oversight of our investment policy committee and behavioral coaching from your advisor. And if you have any specific questions about any of these strategies or how they fit together to meet your particular needs, be sure to contact your Donaldson advisor, or if you're not a client, you can get in touch with us using the Contact Us link in the description down below. Thanks for watching, and we'll see you in the next video.